And that's always something we're very careful to stress with buyers, especially in this environment. It seems impossible that your home wouldn't sell, right? But as we've seen market shift, things can change, and we just need to make sure people are comfortable that that is a possibility.
Hi, I'm Caroline Gow in the Baird and Warner Glenbrook office. Happy summer, everybody. And today I'm pleased to have Aaron Gosser. He's the branch manager of Fairway Mortgage. And I invited Aaron here to talk to us today about the program called the Recast loan. So this might be a term that you're familiar with, but what it actually means is it's when a borrower borrows, what it means is a borrower pays a large sum towards their mortgage principal, resulting in the lender recalculating the loan based on a new balance. So Aaron is going to break this down for us and explain how this all works. But Aaron, thanks for coming today.
Yeah, so this is neat to do. Glad for you to have me.
So what is the benefit to a borrower for doing this recast loan?
Yeah, so it's really kind of come up in conversation because in this market it's just ultra competitive, really is a seller's market, and so it's made buying with a contingency really almost impossible in a lot of instances. So we're looking for ways to feasibly get the borrower into a home without it needing to be contingent on the sale. Two problems when you're not going contingent. One is your income needs to be enough to support both properties. Mm-hmm. The second problem is you need enough money to get into the new home without getting any money from the one you're selling. The recast option is really what solves that second problem, not having the money.
So what are the pros of this compared to a refi? Are the fees the same, or how does it work?
Yeah, sure. So what a recast allows, you can buy a non-first-time home purchase with as little as 5% down. So for most borrowers, they can scrounge up that minimal down payment amount without having to sell their home.
Okay.
Then after you close on the purchase, you later finish your sale, and now you have that big chunk of money that you got back out from the sale. With a refinance, that can be an option. The problem is that depends on where current rates are later. And if they just skyrocket higher after your purchase, then that's just not going to be an opportunity.
Right, or if somebody is buying a home and maybe they need to do some renovation, so it's going to be 6 months before they're going to have their house sold and have that big lump sum, by that time the rates might be higher. Or the other thing is they have to go through, maybe they got a job change and they don't want to have to be approved again.
Or that's actually a great point, or a medical bill shows up and their credit is now trashed and we can't get them. Like, these are all things that are unlikely, but those are risks where like this refinance that was just a done deal, suddenly 6 months later they're now trapped in that loan they purchased the place with. So what a recast allows is you bring that money, you pay a lump sum towards the loan that you currently have in place, you keep the same rate, and then they re-amortize it based on the remaining balance after that recast.
The other thing that's interesting to note about this too is it doesn't have to be because you're buying something and selling something. If you got a large sum, either a bonus from work, or if you had an inheritance and you were given, say, a big chunk of money, you could just put that on your current loan. But what this program would allow you to do is actually change the monthly payment, because if you just put it down, then it's just shortening the amount of time that you have to pay. But if you recast, then that makes your payment lower, which is beneficial too.
So you touched on another great application of the rule. One that perfectly comes to mind when we're getting a gift from a family member or from a trust or something. Let's say it's a gift from a foreign bank account, and translating those statements is becoming a nightmare. One solution to that is, hey, we just close on the purchase with a lower down payment. We then bring those gift funds after closing, so underwriting doesn't have to see them or scrutinize them or anything, and then you can get to the end monthly payment that you wanted without, all the red tape, so to speak. So
what are the fees for doing something like that?
It will vary servicer to servicer. Generally, let's say $100 to maybe $250 on the high end for a one-time recast. Mm-hmm. Most servicers will have a minimum amount you need to bring in order to initiate the recast. You can't just pay $50 and ask them to go. You have to pay roughly $5 to $10 grand minimum. Another downside, typically you will need to wait at least a few months for the servicer to get the end loan into their system. Some of them make you wait 3, 4, 5 months. So in a case where a borrower sells their home literally the day after we purchase, they need to be aware they're going to have to sit on that cash for a while. They can't just make the recast payment immediately.
Okay.
But other than that, I mean, those are the main downsides, if I would even call them that. It's pretty limited compared to a refinance where, who knows, rates could go to 10% tomorrow, and now that option's gone. So
to make it real simple to explain how it works, let's say we're using the purchase idea. So I say to my buyer who's also a seller, look, I know you really want to buy a house before you sell your house so that you're not going to be homeless and you know where you're going to go and what you can afford. So we're going to do a market analysis for the house that you want to sell and how long we think it's going to sell. Then we're going to go shopping, and you can have this pre-approval letter that says, I can buy your home, Mr. and Mrs. Seller, but I don't have to sell my home.
correct.
And does the pre-approval letter from you look any different than a regular pre-approval letter?
No, it really would be the same. I'd say the catch is there, of course. Their income needs to be enough to support both homes at the time of closing. That unfortunately doesn't work for everyone, so it's not necessarily an option for everyone, but oftentimes that will work. And then, you as a realtor, that's an area where you can kind of sell that situation to the listing agent. Hey, the down payment's pretty low, it's only 5%, but here's why. They have a ton of equity in the home. We want to be a really strong offer and go non-contingent, and that it kind of becomes a positive then.
Right, yes, that's true, because that does come up, especially in a tight market. If you're looking at somebody who's putting 40% down versus somebody who's putting 5% down, you might think, if you're the listing agent or the seller, that the 5% one isn't as qualified. Yep. And they actually are, it's just they're doing it. So that's a good point to at least highlight to that seller.
Yeah, and it's very misleading. If I'm a realtor, I think in absolutes as well, lower down payment equals weaker. We see on our end that's not always the case. There's people that put gigantic down payments and they're squeaking by. And some people put very little down, they're very healthy, they qualify easily, they just haven't built up that empire yet,
So speaking of qualifying, are there any guidelines you can give about who would qualify, or any pitfalls that you see about somebody who's not?
Yeah, that's a tough thing to give just general guidance on. I would say generally we're looking at a client's debt to income ratio. We take their total monthly reporting debts, including the purchase we're going to be making, and if they still own the property, including that monthly payment. That usually has to stay within about 45 to 50% of the monthly income we're showing on paper. And that's gross monthly income before taxes. So
gross report. Is it harder for somebody who's self-employed to qualify?
Yeah, self-employed individuals have been frustrating since COVID.
Since COVID, really?
Particularly since COVID. Always a little harder. There's more documentation, a lot more scrutiny, especially since COVID. That's been a tough route. So.
Is the credit a big factor, or is it if you have decent credit, it's okay, or does higher credit make you more qualified?
No more or less than a normal loan.
Okay.
If your credit is enough to meet the guidelines and your income is enough to meet guidelines, then it's an option we can use.
So one thing I think it would be prudent for us to mention is that obviously if you're suggesting either me or you to the buyer that this would be a risk that if your current home doesn't sell, you might have to take a higher payment for a number of months.
Yeah, and that's always something we're very careful to stress with buyers, especially in this environment. It seems impossible that your home wouldn't sell, right? But as we've seen markets shift, things can change, and we just need to make sure people are comfortable that is a possibility. They may get stuck with both properties if they have problems selling their home after.
In terms of getting this loan approved, does it take longer than a typical loan?
No, again, as long as you meet guidelines, everything is roughly the same.
Okay.
It's just when we're looking at that loan file, they still technically own that second home at the time of our purchase. And so we need to treat it on paper like they have two homes. So one thing to note on that, sometimes we're really, really pushing up against the thresholds for qualification when we know in real life that home's going to be gone soon. So It's actually a very responsible purchase for them. On paper, it's very tight. What that allows us is, we can be pretty aggressive with putting it right up against the qualification threshold.
Okay.
Little risk to that, of course, which we explain to the client. But if it allows them a lot of flexibility in their situation where we don't have to sell first, move in a rental, logistically, some of the things that can bring on, it can really help the client to take that small calculated risk. So.
Right, and we're talking about this today because it's just come up recently where the market is so tight and there isn't a lot of inventory to choose from. And somebody that says, well, I love my home, I'm not going to move unless there's a good reason to move, and I need to stay in this school district, school's starting, so I'm kind of only want to buy if I can find something that I like. So in that case, we don't necessarily want to list their house right this minute and sell it and then not know where to go, because finding a rental is not that easy either. So this is just giving some options for people who are able to do it, and just throw that in their hat. So this is all great. What other kind of pitfalls should we know about going into it?
Yeah, so one thing, this is generally available for most agency loans, the Fannie Freddie loans that most borrowers will use. For jumbo products, any loans that are $548,000-ish and above, different guidelines may apply, although generally they will mostly allow recast as well. Also, technically in the guidelines, it says in bold letters, not all servicers will allow a recast. Though before I came here, I looked at all the servicers we have, and literally every one of them does. So it's very common, although I should stop short of saying it's guaranteed for every single lender and bank that's out there.
So is there anything else you want to add to this?
One comment just on the contingent versus non-contingent decision in general we always talk about with clients. I feel like the risk of going non-contingent is obviously you get stuck with two properties a little longer than you thought you would. Mm-hmm. It's a very tangible risk for people. It's easy to visualize, so most people understand that. But we always explain to people as well, going contingent on the property is not perfect either. You're a weaker offer. You're going to have to offer a higher purchase price to get someone to agree to that. So it's kind of a less visible risk, but it's out there as well.
Right, and I tell people I can show you in the MLS that the sellers just are not accepting a home sale contingency. There's a chance that they would accept a home close contingency, because that means you have a buyer that has identified a closing date, they've gotten through their inspections, and then really the only risk is if that buyer loses a job or is not going to proceed.
But you have a bird in hand at least versus,
at least, because otherwise a seller would say, go sell your house, then come back to us because we have 5 other people that are thinking that they could buy our house. So
yeah, and in certain markets, maybe contingencies will come back and be very feasible, particularly for a buyer who's watching the market and wants to pounce on that property that showed up 24 hours ago. I mean, a contingency, at least right now, it just seems like it's not something people will even entertain. So
another reason why I wanted to do it at this time of year is because as we head into the fall and the winter, that's even less likely for a seller to consider a home sale contingency, because then there's even more uncertainty. There aren't as many buyers, and they don't know how long it's going to take. So
yeah, for sure.
This has been fabulous. So
yeah, appreciate you having me.
I'm so glad you could explain everything to me, and hope you can get some value from this. Thank you so much. Subscribe to my YouTube channel at Caroline Gao. Every Tuesday we post new content of local businesses, renovation projects, and market updates to keep you in the know in Northbrook. Bye for now.